All right, stocks rallied again today, back up to where we opened up yesterday. What's the significance of that? Are we now not going to retest these lows? Are we now ready to go full steam ahead? So I'm going to break down kind of what we need to see and if we're getting that right now to say, let's go V bottom to the upside. What would be the consequences of getting a V bottom to the upside without retesting these lows? So I'm going to break that down in today's video as well. We're going to take a look at the signs of how bullish we are on this little rally that we've had, so we can analyze how bullish it is, what our expectations are going forward from here, and then our trade idea of the day is taking advantage of a lot of bearish signals that this particular stock is getting, and we'll talk about how to trade that to the downside. So let's go ahead and get started. Today is Wednesday, April the 8th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and get started here. Take a look at the S&P 500 with the market forecast indicator. You can see this is the first time now, not yesterday because we closed below the moving average, but today is the first time during this decline that we've gotten the light green arrow, light green, yellow line, bearish pattern. Now again, that always precedes reversals too, but again, keep in mind some of these other time frames where we've been extremely bearish. Here, let's go back 20 years and look at the other time frames where we've been really bearish here. Here, let me get rid of, I need to do shows fit studies and do the log scale. All right. So here is this time frame. You can see light green shade, the first time in 2018 in October, light green shading in the yellow line, and then we can see what happened there. And again, we had a second time actually. Here we go over here, light green shading in yellow line, and then we had our pop downs to the downside. And that wasn't even nearly as extreme. Here's extreme here. We got light green shading close to the yellow line. We got that big long upper shadow there, and then we came down. Same thing here. Didn't quite get it. Didn't get the yellow line before we came all the way down and got the divergence there. That divergence low point. Let's go back to 2011. Light green shading in yellow line. You can see that's when we came back down. Over here during 2010, May 2010, light green shading in yellow line, we came down there. During that market sentiment decline. And of course 2008, light green shading in the yellow line for one whole whopping day in October the 3rd, and then that preceded the decline. Here we got light green shading and a green line briefly, and then that preceded that decline there during that market sentiment decline. And then kind of looking for some others, kind of the longer term market sentiment declines. Here we saw light green shading, but they didn't quite get the yellow line. We got the rollover. Here we did get the light green shading and a yellow line. Market sentiment pullback there. During this pullback, light green shading and yellow line just barely, and then we rolled over from there. So you can kind of see how this pattern develops, and here we are now, light green shading in the yellow line. And if you follow me on Twitter, make sure you follow me on Twitter here. I did post out this chart, which is going back 10 years, but this actually goes back to 2011 or 2010. There's the 2011 low, there's the May 2010 low. So obviously we jumped sharply off of March 09, and then we kind of settled into this trend. And you can see how the March 2010 death cross, the August 2011 death cross, the 15-16 death cross ended at that line. The late 2018 death cross ended here, and then this death cross broke us through that trend line. And you'll notice now we are heading right back up to that trend line. So if I were to pull up this chart, this long-term chart, you can see here with the regular candle, we're sitting right at that trend line now, which will be also where the 50-day moving average will be in another week or two. So all said and done, when you look at all these things, I mean, there's some resistance in this area, and we talked about that before too. There's some volume resistance from the Bollinger Bands. You take a look at the Bollinger Bands here for SPY. On the 1 year chart, you can see this is where the value area is, the bottom of the value area, and you can see the volume picks up here into 285. You look at the 5 year chart, and again, this is where right here this volume node is sitting on the 5 year chart, just right in this area. Lots of volume that we had busted below, and we filled in some more volume here, but we had busted below that volume, and now we're heading up against it, and it's the top of the value area in the 5 year chart. So you can see there's actually more volume above us than there is below you right now. So there is some resistance, multiple layers of resistance in this area for the S&P 500. And we've seen lots of examples in the past of when we're in this market sentiment decline, when you get that first pattern of light green shading and yellow line, how bearish that can be. You also see that the Russell hasn't quite got it, and as bullish as the Russell has been today, at least, you notice all it did is get to the 38% Fibonacci line. You also notice the bearish divergence is setting up. Lower high point here with the pattern would suggest a target of this low point right there. In between the two highs. You get the same thing on the S&P. Much higher highs on here, with obviously lower highs in the near-term line. Again, the target to come down based on that pattern would be here, this low point, which would include filling in the gap from last Monday, and of course breaking through that low point would take us to the top of this gap, this potential runaway gap. 2350, which would also be the 38% Fibonacci retracement of the long-term run off the March 09 low point. If you take a look at the Ichimoku cloud, we are still above the blue line here on the Ichimoku cloud, well below the cloud itself. So again, it kind of shows just how we still have a bearish trend according to the trend quality. It's pretty noisy according to the noise balance, but still a bearish trend here. And then, of course, when you look at like the DMI chart, you'll notice that the ADX is still dropping. We got a crossover, but that, as bullish as this is, as bullish as this move has been, you notice that the positive directional index still hasn't gotten above 25. The negative directional index, for that matter, hasn't dropped below 20 either. The other thing we've been looking at too, to see how bullish this rally is, to see whether or not this is like trend-changing rally, is the RSI getting above 60 and the CCI getting above 200, and neither one of those things has occurred yet. So it kind of puts into context the type of move we're getting here, and again sets us up for something of a pullback coming in. Obviously, a lot of that's going to be dictated with how crude oil has been going on. We'll take a look at that in a second, but just from a technical pattern standpoint, you can see that now just as much as this was a divergence that took over a long period of time, with this divergent high point here that happened to be a divergent high in the MACD and the stochastics. Like I said, the near-term line is giving us the divergence there on this high point, kind of telling us that this leg higher might be too high according to the near-term line. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of our screen. Click the red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you would like us to do the video again tomorrow. It's a quick way to give us feedback. Of course, if you don't like our videos and you don't really care, then you don't have to click on anything down there. But if you would like to let us know that you want us to keep doing these, one click, you can do that right now while you're watching. Also, while you're down there, comment on what you got out of the video today. It's always good for people coming to the video to see what everybody's getting out of it. So share with others what you're getting out of it and why they should watch. Join our website at marketscholars.com. There's a link popping out top right corner of your screen up there. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. Alright, if you're watching this on our blog, we invite you to check out some of this other stuff that's on here, our calendar of classes that we have. Keep in mind, our monthly subscribers get access to all of our classes except for two. these two Q&A sessions that we do, one for Brandon, one for me. They are only for our premium subscribers. Our monthly subscribers and our premium also get access to our Market Outlook Live. We had so many people on today, we kind of broke the site for a minute. So I know that's a very, very popular feature. We get a lot of people asking to review the trades that we've done in old Market Outlook videos. Well, that's what we do. Every time I do a Market Outlook, I do the Market Outlook Live at 3:30 Eastern Time before the market closes. We also have already put on today's Market Outlook trade idea, and later in the video, we've already put it on in our account today. Also, engage with us over here. Click this heart. It opens up this window. You can like today's Market Outlook tweet. Click that thumbs up. Again, we invite you to do that. That will ensure that those platforms share our content with you. I've been putting a lot of stuff out there on Twitter, so if you want to make sure you see it, they will only show you the content that you engage with the most. We try to make it really easy for you to engage with us here by clicking on these icons. All right, back to the charts here, and you can see here's the key figure for the Hakinyasha candles in the weekly chart. It's a really good bullish Hakinyasha candle. As of right now at 2750, next week's Hakinyasha will be right around, or next week's open will be right around 2600-ish. So we already have a 150 point body. We would going into, if this is where we close tomorrow. Remember, there's no Market Outlook on Friday. There's no classes on Friday because of the holiday. But if that's where we end up, if the Hakinyasha close, which is not the weekly close, it's actually the Hakinyasha close is the average of this week's open, high, low, and close in the S&P. If that ends up being a pause above this high point and really above this body too, then that's really bullish. If we pull back down to 24 below this, 2641 level, then that's going to be not so bullish, right? We're already kind of flirting with this high point at 2666. We're at 2665.90. So we're really, really flirting. So it's going to be really important to how we close tomorrow. If we close up around here or a little bit higher tomorrow, that's going to be really, really bullish. So how bullish does that mean? Well, that means that we'll probably end up getting to the 50-day moving average, which we're pretty much already there. So keep that in mind. Now, the Hakinyasha is not there yet, so we can still we can trade around the 50-day moving average and get the Hakinyasha up there. But that's probably right now the extent of how bullish we'll get. If we go through the 50, now we're gonna, there's a good chance we fill in that gap. But in the past, when there's a big gap here and we've gone way below both. The first resistance, in this chart at least, will be at that 50. And also keep in mind this trend line, too, that's going to act as a resistance, even on the long-term chart like this. Take a look at the 3 green arrows. Of course, we have 3 green arrows now. So just like 3 red arrows can be a bullish signal on an upward trend, 3 green arrows can be a bearish signal on a downward trend. So that's something to keep an eye to. This little rally we've had, look at the volume dropping off considerably during this rally, all well below the average. So pretty significant from that regard. If you take a look at the two line versions of this chart, where is it? Right here. 2 line versions, you see the 8 day is just barely crossing the 17, so the MACD is just sniffing its toe above 0 here. Histogram as high as it was on this bullish rally, so a little bit of a divergence on the histogram at least. Both lines still below the 30-day. That's kind of the last stage of reversal, and so keep that in mind. We've had this nice little rally here, the MACD from really low levels all the way to 0. It's not too common that the MACD goes from extreme lows all the way to extreme highs, right? Usually when we go to like it did over here, usually when you get the extreme lows and the extreme selling, which actually occurred here in October, we make a run up to the midpoint and then we retest. We make a run up to the midpoint and then we retest. We make a run up to the midpoint and then we retest. Same thing over here. In this case, got a higher low point. So that happens quite a bit, where we make a run up. Here's the last time we were extremely low. Again, very few times we've been this extreme, but the last time we were extremely low, we made a run up towards 0, hit that, on the same pattern on the market forecast that we got now. That happened right there, and then we came back down and got the divergence, right? So that's the expectation here, is that this extreme low, we're probably going to get some kind of divergence off of this potentially, which again would mean a potential move down towards 210, 2100 on the S&P. So we'll see if that ends up happening or not. That's a less likely scenario, of course, but we've seen, like you said, in 2008 we saw that happen there. So it's not out of the realm of possibility at all. Just a matter of how bearish we get on the next little pullback, next move to the downside. But you can see again, it's not too common to go again from extreme lows, this extreme especially, all the way up to now extreme highs. Usually we kind of peter out around the midpoint of this chart, which means the 8-day moving average gets up to the 17-day and is unable to really break through to a really strong upside move. Because that's what this MACD measures, is the gap between the green line and the red line. It got to the lowest point over here, and now it's been rallying, and usually it diverges. Usually it pulls back down from the 17 after floating around with a crossover up above it. All right, now let's take a look at the intraday chart, and you can see we got right back up to that 275 level that we kind of hit here at the open yesterday. We came down, traded right back into it, obviously filled in the gap on the pullback. Now the question is, do we hit resistance here again? There's that gap over there. There's a little bit of a volume node, of course. You've got very little volume above us, so we can go up further. You have very little volume below us. Interestingly enough, this is the 4-week chart. Like the 4-week high, which has been over here on the left-hand side of the chart for so long while we've been bearish, is now going to be right here. Right, this is going to be the new 4-week high point. We just barely hit at the close today. So the high tag is going to be all the way over to the right-hand side of the chart. And then now the low tag is going to be the one that's going to be progressively getting. I mean, we're not going to be testing that low point anytime soon, at least not within the next couple of weeks. So eventually the low tag is going to be the one that moves up to here and then to here for the next couple of weeks. So the tables have turned on an intraday basis. So kind of interesting to see that transformation here on the 1-year chart. Let's take a look at the volume. I told you earlier about the volume being really below average. The second lowest volume besides this day, this really small range day that we had last week. 153 million. The trading range under 13 points at 10 points a share. So if you come over here to the range, this chart right here, you can see 10.775 points. It's down here. That's not 3%. It's getting closer to 3%. But it's starting to bring this average down, starting to bring this down. Remember, these, the low point typically is formed when this line gets closer to 3%. So that's kind of why I think there's still some opportunity. Again, anything above kind of like 2.75 would be about 7.75 points. Probably about eight points or so. Okay, 8.25. Now they got the calculator out. That's 3 points. So anything above that will keep us above 3% mark. So if we have any kind of declines, or if we have some big moves to the upside, keep that in mind. But also, again, as we go up and down, watch for this line to get down towards 3% before we finally, hammer out the low point here. You notice too on a lot of these charts, whether it's a weekly chart or it's really the monthly chart, it's the only one that's got the long lower shadow. And we've seen in the past when we get these long lower shadows, we tend to trade in the range of that for at least a month, if not a couple of months. So that's why it's like, okay, we're just a week into April. How likely are we not to trade within the range of that long lower shadow? Here it's obviously a very, very unlikely. So we shouldn't get too worked up over a nice week and a half, and think that a lot of these patterns now won't play out like they have in the past, because maybe this time is different. But again, the more people feel that way, the more likely we are to turn around, right? That's how the market functions. It tries to draw people off of the bandwagon from the crowd, right? It tries to create pain. So if there's a bandwagon thinking that we're going to go up from here, then that's when you'll come back down. If there's fewer people on the bandwagon that we're going to pull down, that's when we'll pull down. So that, again, it's all about creating the most pain possible for people. If there's a lot of people waiting for the retesting of the lows, then it will keep going up, because then that's the pain, right? The pain of sitting in cash. So that's why, again, you don't have to wait necessarily for the retest of the lows to get bullish. I told you before, long-term investors, had you bought at the worst of the worst in the October selling, you would have been down 5 months later 25%. But despite the initial 5 months, the rest of the 7 months were so bullish that the 12-month return was still 20%. And then the 10-year return averaged 20 by 2018 over here. The 10-year return averaged about 25% a year for 10 years. So whether you got in October, whether you got in May, whether you didn't even get in May and you got in or March, whether you got in May or June, either way, you would have really good returns 1 year later, and you would have really good returns 5 and 10 years, average annual returns 5 and 10 years later. So from a long-term perspective, it doesn't matter whether we retest the lows, whether you get in at the retest of the lows or not. So that doesn't matter at all. From a short term, obviously, from an active trading standpoint, that's what we're talking about. And that's, you can, as you see, like in our classes that we have at Market Scholars, I had someone comment, how crazy it is for us to have both bullish and bearish trades on in our portfolio, in our class portfolio, expecting the pullback with the bearish trades, and then having some bullish trades in case we, on the dips, when we get these little dips, putting some bullish trades on in case we continue to go up, and how we can be able to manage having both trades on at the same time. So in our active trading portfolio. Of course, in our long-term portfolio, the long-term expectations, at least the intermediate-term expectations, what drives how we position ourselves there. And again, doesn't matter, right? It doesn't matter whether I get in today or tomorrow or a week from now and wherever we're at, because again, where we're going to be at a year from now, that's what matters. Where are we going to be out 2 years from now? And I don't believe we're going on a 10-year run, because the CAPE ratio is already really high. But I do think that we're going on a pretty good 1-2 year run at least. And we'll, from a long-term perspective, that's how our portfolios are positioned. And again, it doesn't matter whether we V-bottom. I'm kind of hoping we don't V-bottom, because if we do V-bottom, I can't imagine what an actual bear market's going to look like. Like, if we V-bottom, then this isn't a bear market, right? I mean, just like this wasn't a bear market, because we bounced up, right? If we V-bottom and we go right back up to a golden cross like this, right? This and up, this and up. These were not bear markets. These were not bear markets, right? The obvious bear markets that stand out to you on this chart are this one and this one, right? This was not a bear market. This was not a bear market. This is not a bear market. And if we V-bottom, this wouldn't be a bear market. Even though we fell 35% in 4 weeks, that doesn't matter. A bear market is when we are in this death cross environment for months, months and months. This wasn't the case there. That wasn't the case here, and it wasn't the case earlier in 19, and wouldn't be the case here for V-bottom. So if this is not a bear market, and these aren't, and this was a pretty steep drop too, and now we've got an even steeper drop. If that doesn't produce a bear market, at least of multiple months, like 1987, right here, go out all the way over to here, right? So I mean, this wasn't the same, but you can see how that was more of a bear market than any of these were. See how thick the pink shading was. We went from October. By the time that we got the golden cross that stuck, it was about a year later. I mean, that was just a 1 year bear market right there, and that's how that looks compared to these two. So keep that in mind, that these are not bear markets, and this wouldn't be either. And again, what would it take? Right, this one took a 20% drop in a single day. I don't know what it would take if this doesn't produce something. If the current drop doesn't produce something at least like 1987, where we have we come up, we bounce up like we did. We bounce up really hard here, as you can see on the regular Hakinashi candle. We had a nice good rally in a couple of weeks to get off of this low point. That was this low point's the Black Monday. We came sharply off of that, stayed in this bear market environment even after retesting the 50, coming down a little bit and then breaking through and filling in the gap and failing at the 200-day moving average. This process took months to occur, right? Because here's October, mid-October. By the time we got above and really got above and stayed above the 200-day moving average, it was in mid-September of 98. So that process took months. So if we can't even get something like this out of the current move, then I don't know what it will look like. Like I can't. It's going to kill a lot of people. At least from a trading standpoint, emotional. I mean, not from a coronavirus standpoint, but from a trading and emotional standpoint. No, we're not going to be able to handle it. A market like this or a market like this, if this current drop doesn't at least produce a base. I mean, that's a pretty solid base that produced a good long-term move. We had a good long-term move going into it. That was enough of a solid base that we got a good long-term move coming out of it. Again, this is not enough of a base as of right now to produce. I mean, you can see this one here, the one that we had in December. Obviously, we had a good 1 year run out of it, and then boom, back down. This one had a couple of years run before we had some volatility. So we're not building big enough bases with these little bear markets to say, okay, we're going to get a good multi-year run out of this. This wouldn't be either. So that's why I would prefer, just from a long-term perspective, considering the bulk of my portfolio is in a long-term portfolio, I would prefer that we don't V-bottom. But if we do, then I don't, then when we get back up here to the top, you'll see me get really, really safety oriented in my long-term portfolios and my trend trades and things like that. You'll see me get really safety oriented because I'd be very, very concerned, like I said, about what the beginning of a bear market actually would be like. I'd still be bullish because obviously if we got up to these highs, it'd be bullish again, but I wouldn't be nearly as bullish as that I was even over here when we were really bullish coming off of that low point. We had some really good returns, and that we started dialing back the risk this year in January and February that we talked about in those videos. We were still bullish, obviously, but we started dialing back the risk before something like this happened, right? Again, if this isn't a bear market, then boy, howdy, what one's going to look like eventually. All right, so before we look at some other charts to just kind of summarize the technical outlook, we've had a nice good rally up to this point. We're getting very bearish signals, and a lot of signals are showing that this rally is not nearly as bullish as we see. And we'll see more of that here in just a minute. But just from a pure technical perspective, we're getting a pretty decent bearish signal right now. Again, that doesn't mean that tomorrow we're going to tank. It might take a week or two for that bearish signal to play out. Because remember, we're not going to fall nearly as fast the next go around as we did going into that March 23rd low point. But it's a bearish signal nonetheless that we've seen plenty of in the past in this type of market sell-off that we've had. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. Why are you more bullish than I am right now? Why are you more bearish than I am right now? And share what's driving that opinion, whatever chart or indicator you're looking at with the market scholars community down below. All right, now let's transition to some of these other charts I told you about why maybe we're not as bullish as we think. You can see since the March 23rd low point, of course, crude oil initially struggled, and then it's had a nice good run before pulling back the last couple of days and bouncing today ahead of this OPEC meeting. Despite the fact that stocks are up 23%, crude oil is only up 10.5%. That's okay. But small cap stocks are only up 18%, and that's not okay for a move off of a low point. We want to see the leadership change, right? We want to see the leadership change from U.S. stocks to international stocks because of a falling dollar, and that hasn't happened yet. We want to see the leadership change from large cap stocks to small cap stocks, and that hasn't happened yet. We want to see the leadership change from growth to value, and that hasn't happened. So if you take a look over here at the growth and value stock chart, the ratio chart for growth versus value, here, let's pop, there we go. And let's go out a little bit longer term so you can kind of see how this has been trading. And again, since the beginning of the year, during the rally, it did really well, and during the pullback, it still held up really well. Now, it looks like there's signs of rollover, but just to kind of give you an idea of how bullish this ratio has been, it's been really, really bullish for quite a while. So we want to see that leadership change from, again, large cap growth, in this case, growth oriented stocks, large cap and U.S. stocks to the alternatives, right? Value, eventually growth will retake the mantle, but value usually at the very, very beginning, and I don't know if this will go back. We'll see how far it can now go back. It does go back a little bit. Let's see here. How far does IVW go back? It does go back to that far, and then IVE, does it go back to 08, 09? Okay, so let's go back to the ratio here. Here, let's go back to ratio charts. All right, you can't really see it because we got this big spike here for whatever reason that throws off the scale of the chart. So you can't really see this segment as well. Here, let's see if I can't do this and zoom in as best as I can. So we'll do log scale and auto, and we'll fit this up. Okay, so here we go. So trying to zoom in again and try to take out the crazy spike. So this is 08 and 09. You can see in March of 09, see how growth rallied during the decline relative to value. But then when we hit that low point in March, and we first came off that low from March to September, value outpaced growth. And then growth took off from there, was able to regain the leadership. So, you know, we want to see that again here. We want to see value take over the leadership and bring this back down. That's when you know we have set in the low point. And we haven't seen that yet, right? We're still really bullish, and U.S. stocks are still really bullish, which means the dollar has been really bullish. We want to see the dollar not be so bullish, and we want to see it start, and it's starting to. We want to see it start to roll over to the downside. So here, let's bring up this chart. Well, not this one. Yeah, this chart here. Let's bring up the market forecast chart and bring up that dollar index. And again, we want to see more of a rollover here to the downside. We want to see dark pink shading and a red line, and we haven't had that for a while. Briefly over here, but you can see that we're now, you know, after this little bounce, we're not bouncing up to new highs. In fact, we're kind of, this is a lower high, and as of right now, starting to roll over. So, you know, there are some indications that the dollar rally might be nearing its end. Of course, that coincides with weakness that we've had in the euro and the pound, sterling, and other currencies. Right? Again, they've been so bearish against it. We'll see if the pound gets another leg of weakness down here to the downside. But for the dollar to show some weakness, we need these currencies to show some strength that they just haven't had for a while. You take a look at their long-term charts. You know, there's the pound, right? It's been so bearish, and it looks like it's settling down here, but still in a death cross environment. And then the euro US dollar, same thing. Lots of volatility, and it's still in this death cross environment. They need to get to golden cross environments before we're really able to get going on a new move up to the upside. You look at, you know, here's that March 09 low point. We were in a death cross environment there because of how bullish the dollar was. But you see how a rally in the euro helped get us up off of the low point in March of 09, and we need to see something similar here where we get a good move up. In this case, if we have similar to this, a good move up back towards 124, 125, that will really entrench us in the good rally. But, you know, closing above the 200-day moving average, right? That's going to be the kind of thing we need to see. And staying there, because we haven't stayed there the last two times we closed above it. We need to get above it and stay above it for us to feel really confident about the low point being set in. From a sector rotation standpoint, again, I brought this up to you Monday. It's worth mentioning again because of how important it is the leadership off of the low, right? The leadership off of the low should not be the trash. And that's, as of right now, that's what we're seeing off of this low point. I mean, look at utilities and real estate are still the biggest winners because of how low the yields are. They're the biggest winners during this bounce up. Industrials, financials, energy. I mean, this is the trash. Your cyclical areas that typically are your strength, your leadership, they're lagging behind. They have, they're neither one of them are getting up to XLK a little bit above 20%, but they're not showing us the strength that we would like to see on a bounce up. So as we pull back, then you'd expect the safe haven sectors, staples, utilities and real estate especially, to kind of hold up during the pullback, and you'll see a lot of this trash come down a lot. And then you'll see the cyclical areas hold up a little bit better. And then on the bounce, then that's when you'll see these guys take off to the upside. So that will be your sign too that the low point has figured in, that we've changed the leadership from the trash and these low yield, these yield sensitive, interest rate sensitive sectors to your cyclical leaders, your typical cyclical leaders, your consumer oriented leaders, since that's a dominant portion of our economy. Here's the 12 sector, and here's the 12 grid, and you can see they're all showing us the same pattern. Light green shading and a yellow line. Almost all of them. The only ones that aren't are XLF, which is almost there, and then XLV and staples, which are a little bit above 50, and so they got the dark green. Those are the only ones. Everything else is showing us that same bearish pattern of light green shading and a yellow line. So our trade idea of the day is one of these stocks that looks just like this, actually in this healthcare sector, because it's been so bullish, kind of giving you this kind of potentially a fake breakout type move. If you take a look at Anthem, it's kind of blew above, got to the bottom of this gap, but kind of blew above its moving average, yellow line, light green shading. You see that there's some resistance up here in this area from a volume standpoint right above us, some very significant resistance right above us. You also see that not only is that a resistance there, but you also see that the 50-day moving average is sitting right where we're at right now. That's going to act as a resistance level as well. You look at its DMI, like so many of the other stocks we've looked at, its positive DMI has gotten above 25, but its negative DMI, which has been so dominant here during this pullback, is not. This has barely dipped below 25. It's not below 20 yet. So its Ichimoku cloud is also giving you its own bearish signal with Anthem closing above the blue line, below the cloud. So that's a bearish signal as well. And then you look at the three green arrow chart. In this case, the two-line versions. Obviously, we're getting three green arrows, but you see its 8 and 17 day are also still below the 32. So, of course, anything can break out, but there's a good, there's a lot of bearish signals lining up here for Anthem here all at the same time. So obviously that means that we can take a look at a bearish trade on this. So here, let's get to single symbol, and we'll take a look at Anthem here. And again, we've already placed this trade, but selling the 210 put and buying the 220 put, that gives us a bearish trade to the downside. We only did a couple contracts, so we did a half a normal position because of the speculative nature of the trade, right? It either will take off or it will drop sharply to the downside, and so we got a good 3-to-1 reward to risk ratio. If it doesn't, if in the worst case scenario, if it breaks out to the upside, then we can cut our loss in half and have a 6-to-1 reward to risk ratio with a good reward, $1,500 for only a few $100 of risk. I like that. That's the kind of ratios we want to see to the downside. So again, we're buying a put for $9.85. We're just offsetting a good chunk of that cost of that put, and it's an out of the money put. We're offsetting a good chunk of the cost of that by selling the 210 put because we don't think it will go down very far. We're just not sure. We might retest those, but who knows? And I'm not going to do any bearish trend trades here anytime soon. So I'll cut my gains off at 210 and really reduce the cost. I mean, the cost of my puts $500, half of that for one contract, but a good reward to the upside if it does indeed work out. Very similar to a bunch of trades we've done lately in the Market Outlook videos. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. All of our subscribers, free subscribers, monthly, premium, can all participate in our Market Outlook forum. Post any questions or any comments you have about today's Market Outlook video there, and reply to anybody else's threads too. The point of this is that we can interact with each other as a community of Market Outlook watchers. And let's keep this conversation going in between videos. Again, thank you very much for watching tonight. Remember to hit that thumbs up icon, subscribe to our YouTube channel, comment on our video, follow me on Twitter for more content in between the videos. Make sure you follow me there, and then join our community also at Facebook, our Facebook group that we've created. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.